Yeah, and if you allow me to go 2 months further back, so I was able to put those predictions out in June 20th. It was, I guess, and I said it would be 47 in August, 43 in September, then 63 in October, 98 indeed in November, big miss, and 135 in December. So after those three hits, some people indeed thought I was Satoshi or a guy from the future, which of course I am not.
So you say, but okay.
Yeah, just a guy with a model. So what went wrong? Yeah, well, lots can go wrong. All models are wrong, and some are useful. George Box used to say that. It's a very famous saying. All models are wrong because they're simplifications of reality, but they can be very useful, like the navigation in your car, for example. It's not reality, but it brings you from A to B. And the same is true for models. So what went wrong in this model? Well, lots has happened, right? We have seen, since we last spoke, the Chinese mining ban. So half of the mining capacity was located in China. It was banned, and it relocated to all other places, the US among them. We have had an Omicron, a new COVID variant that gave some flashbacks to March 2020, when the market dipped to very low levels, including the Bitcoin price. And we've seen the Evergrande default now recently. So there's all sorts of news that sort of impacts this Bitcoin price that is, of course, not in the model. And a very important thing about the floor model miss of 98,000 in November is that this is a first time in 10 years that we see this miss. So this model has, of course, in sample, so with hindsight, hold for 10 years, but now this is a first miss, and it could be an outlier. It could be a one-off or 2 months off, and then a sharp V-shaped recovery back to the model lines. Or it could be that the model is wrong, is off. Something changed. The model is not usable anymore. And I'm still not at that point of making that decision, whether the model is just off temporarily because of an outlier, a black swan, or whatever, or that the model can be thrown into the trash bin and is off structurally. There was a lot of leverage. There was the open interest on the future exchanges was very high, right, and it dipped hand in hand with that price drop. So, but we see that all the time, right? All the price movements in Bitcoin are amplified by the derivatives positions, and especially the exchanges that allow very high leverage, like 10x, 20x, or even 100x leverage. And people that enter into those exposures, of course, have to put in stop loss orders.
Yes.
Which are visible to people that pay for that information, and that, of course, is a very, very dangerous thing to do, especially with a volatile asset like Bitcoin. I would recommend not using leverage, and certainly not 10x or 100x, which is madness.
Has there been anything in the last 7 or 8 months since I had you on to cause you to lose any faith? And is your percentage of ownership in Bitcoin still high?
Yes, I did not sell a Bitcoin, a fraction of a Bitcoin. I just hodled
Diamond
through.
hands.
Yeah, diamond hands indeed. So yeah, it's and like we talked last time, you always start with a small allocation of 1 or 5 or 10%, depending on your risk appetite. But then, yeah, after a couple of years with these growth rates in the past, at least, that small exposure turns out to be indeed 50+% of your portfolio, and it's still 50+.
only Bitcoin, or have you explored other aspects of digital assets that may be worth getting into and diversifying into?
Well, I am Bitcoin only because I like Bitcoin for the reasons it was made against debasement and the whole battle of, the separation of state and money. So I guess Bitcoin is the best in terms of decentralization, in terms of, a lot of things. But I can certainly understand from a pure investor's point of view that there are other cryptocurrencies like Ethereum or Doge, you mentioned, yeah, or whatever, or
Avalanche. I can name them all if you want. I could give it a shot.
Yeah,
but I don't have the time to do that because there's like 100,000 of them.
Yeah, exactly. And I mean, I see a lot of investors, like Raoul Pal is also not a maximalist, and he's an investor too. So, sure. And I see a lot of the big hedge funds, like also the flash trade companies, that the really big companies that are used to working in the dark. You wouldn't even recognize their names, but they move billions. And they're into all this staking, right? The 7,000% staking return coins. And of course, there's a lot of risk in there, and there's maybe a lot of fraud and in there as well. But I guess there's a lot of money to be made, and if you're in the right groups, if you're connected to the founders of these projects and have the information first, so you know when they pump and when they dump, you can make an awful lot of money. But that's just not my game. It's for me, that's more like gambling. But maybe I'm getting old as well.
If you got something that's a tremendous risk reward, you may need to change your allocation, adapt what you've done in the past, and let certain things run. Now, again, people are going to argue, well, June came along and things went down 50%. Well, just have diamond hands and hold on, and look what happened. But what's your putting on your institutional allocation hat? I mean, you probably were breaking some rules here, having Bitcoin become over 50% of your portfolio.
You're absolutely right. And we're probably about the same age. So I have that same portfolio theory thought in my mind, that you rotate back to your initial mandate, and especially in an institutional setting. Of course, you have a mandate that you can have X% in some asset and Y% in another asset, and you have to keep your exposure within those mandates. And if you start with 10% Bitcoin and that grows to like 80% Bitcoin because it doubles and doubles and doubles again, then you have to rotate out of that asset and into another asset. And I might say, in an institutional setting, you have to do that. Personally, I don't have that strict mandate, of course, for my own money, but it would be wise to have some kind of protection built in. And I have friends that have very simple asset allocation rules, like, okay, I want to have 25% in real estate, 25% in gold, 25% in stocks, and 25% in Bitcoin. I rebalance that yearly or quarterly or whatever. And that would be like conservative. I think that would be not a bad approach at all. On the other hand, I must say, it's always difficult, even for institutional investors, but they're bound to their mandates. I am not personally. It's always difficult to sell the fastest horse,
yes.
to speak with Paul Tudor Jones. And so I guess I sort of ignored the mandate, my personal safety for a little bit, and let the fastest horse run wild.